Today is Monday, February 15th, 2021, and I'm your host, Max Gottlich, and I talk about my interpretations and insights into financial markets and the global macroeconomy. A combination of debt held by the public and intragovernmental holdings yields the total public debt outstanding, which, by the way, in the case of the US, totals $27.7 trillion. That's right. And as you can already guess, debt held by the public beats intragovernmental holdings by a factor of over 3 times. Now, the monthly state of the public debt, which is a monthly report, which basically shows the total public debt outstanding in the US, and MSPD, it actually lists out the outstanding securities, ranging from bonds to treasury bills and treasury notes, all that stuff, and remind you that debt held by the public is all federal debt held by people and businesses and muni governments and other government entities, and as well as intergovernmental debt. That's just debt that the government owes to itself, essentially. Now, let's start with the summary of Treasury securities outstanding, which obviously, like we just mentioned, it's divided between debt held by the public and intragovernmental holdings. So T-notes or Treasury notes are clearly the most popular marketable debt or marketable security, across the board. In fact, Treasury notes represented roughly 53% of outstanding marketable debt at the end of 2020. So you look at non-marketable debt, right? We just talked about marketable. Now, the Treasury offers non-marketable as well. And you see that the government account series literally accounts for the entire intragovernmental holdings, probably about 35% of debt held by the public. So, and so the government account series is really just simply a portion of debt held by the government entities, and they have funds on deposit, with the Treasury. I should also probably add that the U.S. Treasury offers marketable and non-marketable securities, like I said, where marketable securities, they're traded on secondary markets, and they also, there's also the non-marketables, which are direct issues to the buyers. So there's no auction, there's no nothing, there's no secondary market. But marketable securities, right, the ones that are auctioned off, the ones that do have secondary market, they actually make up 97% of all debt held by the public. That's as of the end of 2020. In fact, I'm looking at the current policy press release from February 2nd, and the first two sentences literally says, and I quote, "The U.S. Department of the Treasury is offering $84 billion of Treasury securities to refund approximately $70.5 billion of privately held Treasury notes and bonds maturing on February 15th. This," end quote, not end quote yet, "and this issuance will raise new cash of approximately $13.5 billion, end quote. All right, so, and, obviously these auctions already happened, right? And we did some pretty good auction, we saw some pretty good auctions across the board. There is still quite some demand because the Fed continues buying these, long bonds, and more so on the short end of the yield curve with notes and bills. But the problem is more stimulus will not solve the unemployment issue. In fact, it'll only exacerbate the unemployment issue and literally decrease overall confidence in the value of the US dollar. And just add back the people that no longer are part of the labor force, or the U6 unemployment rate, or in other words, the real unemployment rate, which is actually about 10% and probably much greater than that. You see that the actual unemployment rate that's on the Fed now, they say it was revised from, I think, 6.3%, no, from 6.8% to 6.3%. But again, just add back those people that aren't part of the labor force, and that quickly jumps to over 10%. So, and this always makes me contemplate on whether or not we will see negative real yields in the near future, which, I suppose it's a fair possibility considering what we always talk about, the reckless monetary and fiscal efforts to quote unquote maximize unemployment and stabilize prices as part of the Fed's dual mandate. Well, this week we've seen West Texas Intermediate crude trade over $60 a barrel, which is definitely considered a psychological whole number area of technical resistance. And keep in mind, I mean, crude futures actually saw negative prices during April, and now it's trading over $60. So tell me that's not inflation, because it is. And I think oil has much more room for the upside. And it is inflation because, I mean, oil energy is such a huge part of headline core CPI. Excuse me, not core, of regular headline CPI. Core is in excess of food and energy prices. And, you've got a steepening yield curve with US Treasury yields starting to really climb as inflation expectations climb as well. And, even France's, and this goes for the whole Euro area as well, but specifically France's 10-year bond yield reached its highest level since last September. And of course you got easy money. So companies issuing almost $150 billion of junk rated bonds and loans just this year alone. It really doesn't surprise me one bit at all, because with easy money comes a greater incentive to borrow and lever up. So the discounted cash flows in present value terms clearly isn't justified by the overextended market values that all these securities and the stock market itself is trading on. So I think you can call the stock market a bubble, because we're seeing the classic environment of euphoria chasing euphoria. This is all I wanted to go over for today. I hope you enjoyed, and please like and comment on the video and subscribe. And of course, please note I'm not a financial advisor, and everything I say is for informational and educational purposes only. Okay, thank you.